Hi, this is Nick Pollard, and I'm going to go through our most recent edition of our signals report. So this covers data through the end of April. So the title of this report is Neutral Indicators Make High Quality Float in Tepid Waters. Sort of the idea of this is that our two of our primary indicators, the Cirrus Risk Score, our measure of risk appetites, and the CPQ, the Cirrus Polarization Quotient, are both firmly, for the case of the CRX, risk appetite in neutral territory, and it's been there for 10 months. And our measure of crowding, the Cirrus Polarization Quotient, remains also firmly in neutral territory, where speculative crowding is not a concern. However, one area that is demonstrating a strong signal is the Cirrus Tactical Size Premium model, which indicates that large caps remain in favor. This is a relatively strong signal, and as the profit cycle continues to slow, large caps should remain in favor. One thing to note is that one of the indicators pointing in favor of small caps is valuations. And in particular, as we outlined last month as well, small cap growth remains at a sizable discount to large cap growth. Looking at the Cirrus style oscillator, we've seen that the indicator just moved into lean growth territory after oscillating a little bit between lean growth and neutral territory. Something interesting to note about this reading is that whereas in the shutdown and recovery from the pandemic, we saw valuations for value stocks as comparison to growth stocks extremely attractive. However, at this point, particularly for smaller stocks, we see that on a historical basis, relative to growth stocks, value stocks are actually not as attractive, and growth stocks have attractive valuations. Finally, to go into small caps a little bit more, and to, in particular, look at the momentum baskets or hot stocks, and we often like to look at the valuations of hot stocks relative to the rest of the market to get a picture of the degree that people are getting exuberant about the most aggressive stocks of the market. On the left, we have the results at the end of March. On the right, we have the results at the end of April. So what this is the sector composition of the top momentum basket for small caps. You can see that technology increases its exposure to 17% from 10%. Healthcare decreased its exposure from 24% to 18%. In April, at the start of April, end of March, financials still had a small presence. However, much of that had been flushed out following the Silicon Valley bank crisis, and that weight decreased even more. Consumer discretionary is now in. So in some ways, the current momentum basket is starting to look a little bit more like the pandemic basket for small caps, with healthcare, technology, consumer discretionary all having substantial weights. Industrials still have a substantial weight as well. However, the other cyclicals, energy, you can see decreased from 90% to 9%. Materials has fallen off of the chart. And as well as financials. So from that perspective, you can see that the strong cyclical bias in small caps, leadership has rotated away a little bit more back to the pandemic leadership. So just to reiterate, the one change in indicators was that the Cirrus style oscillator moved to lean growth from a neutral position. Otherwise, all the indicators remained the same. So large caps were in favor. Once again, no concerns regarding risk appetites. It's in neutral territory. No concerns regarding crowding across size caps. we have seen this rotation away from cyclicals in terms of leadership in smaller stocks. Thank you.